If you live and work in Canada, you likely already have plenty of exposure to the Canadian market through your bank account, your home, and maybe even your job. This is why many savvy investors look for a way to own everything else. Enter VXC, the Vanguard solution for Canadians who want to own a piece of the entire global economy minus Canada. While many people default to S&P 500, VXC offers something a little bit broader. It gives you the massive tech giants of the US, but also adds the stability of Europe, the innovation of Japan, and the high growth potential of emerging markets like India and China. Today we're looking at what's actually inside the fund, comparing VXC to XAW, and seeing if this is the best way to diversify your wealth away from the Canadian loonie. So let's get right into it. So what is VXC? Officially, it's the Vanguard FTSE Global All Cap x Canada Index ETF. In plain English, it's a one-ticket fund that buys thousands of companies around the world, specifically excluding anything in Canada. It's a fund of funds, meaning you buy one share, you're actually buying a slice of 4 other Vanguard ETFs that cover US large caps, as well as small caps, developed international markets, and emerging markets. The fund is built for the set-it-and-forget-it kind of investor. It holds over 11,000 different stocks, making it one of the most diversified tools available to Canadians. And because it's listed on the TSX, you buy it in Canadian dollars, which makes it incredibly easy to hold in a TFSA or RSP without worrying about the currency conversion fees at your bank. The biggest rival to the fund is iShares XAW. When you compare VXC to XAW, you're essentially splitting hairs. Both have nearly identical fees with an MER around 0.21%. The main difference is the underlying ingredients. XAW uses iShares funds, while VXC uses Vanguard's funds. Historically, XAW has been slightly more popular by volume, but VXC has been catching up as investors lean into the Vanguard ecosystem. You might also be wondering, what about VEQT, for example? Well, VEQT is an all-in-one fund that includes 30% chunk of Canada. VXC is for the investors who wants to choose their own Canadian exposure. If you already own a lot of Canadian dividend stocks, for example, like banks and utilities, buying VXC is a smart move because it adds global diversification without doubling down on the Canadian companies you already own. When you look at the VXC Holdings, you'll see that it's heavily weighted towards the United States, which usually makes up around 60 to 65% of the fund. This is because the US stock has the largest stock market in the world, so you're getting massive exposure to companies like Apple, Microsoft, and Nvidia through the underlying US ETFs. The other 35 to 40% is where it gets interesting. You get a solid 25% in developed markets like Japan, the UK, and France, plus a small 10% kicker in emerging markets. And this geographic spread is your protection. If the US market has a flat decade, but international markets boom, VXC captures that growth entirely. It ensures you aren't betting your entire retirement on just one country's economy. A common question is, does VXC pay dividends? And the answer is yes, it does. It pays out a quarterly dividend typically in early January, April, July, and October. Because the fund holds thousands of companies from dozens of different countries, the payout is a mix of those global dividends. The yield generally hovers around 1.4 to 1.6%, and while that's lower than what you get with most Canadian dividend funds, remember that VXC is built for growth, not income. Most investors set up a drip to automatically invest or reinvest as payouts, and this way your global snowball keeps getting bigger and bigger and bigger with every quarter without you having to lift a finger. So is this global giant the right fit for your portfolio? I would say it really comes down to how much Canada you already own. Choose VXC if you already own individual Canadian stocks like banks and pipelines and utilities, and you want a simple way to add the rest of the world to your portfolio. Then choose XAW if you prefer the iShares family of funds or you want a slightly higher trading volume. And choose VEQT if you want a truly lazy portfolio where Canada is already included and you don't want to manage multiple ETFs. Anyways, guys, thank you for watching. If you found this breakdown of global diversification helpful, hit the like button and subscribe to the channel. Thank you so much for watching the video, and I'll see you in the next one. Take care.